Welcome to Subramani. I found a document by William Locke, who is the head of international equity for Morgan Stanley. He had some 10 points on what he learned from the equity market over the last 20 years. So I thought I will make a video on what he learned and what my learning was and how is there a similarity. So the first one he says is buy good stocks and get away from the way of compounding. I completely agree, and he says how Morgan Stanley is a great stock picker all over the world. Of course they are. I'm sure they must be having a good portfolio, but in my case, I pick up stocks in the Indian portfolio, but internationally I put it into index funds, right? I put it into 2-3 index funds which decide whether to put it in China or Japan or US or Europe, whatever. They decide, they allocate. So I don't do anything, I just do an SIP in that. Having said that, I do pick stocks within the country because presumably I understand a little better within the country, though of course I hold shares like Tata Motors, which I don't understand because it's too big an operation, right? Multiple countries. So should I be happy that the pound has fallen in value or should I be unhappy that China demand has gone up or gone down? I have no clue. So Tata Motors is there in my portfolio. Once upon a time I used to understand it, but now after JLR and all, which is much bigger, I can't claim to understand its balance sheet. So these are exceptions, but normally outside the country indexing, within the country I pick up stocks. So I have picked up stocks over the last 40 years of active investing, and it has helped in the sense that I've been able to say what I need in a company, and I keep looking and I keep throwing out companies. Sometimes it's a mistake, sometimes it's right that I threw it away. For example, I sold Orkay at a very good price, and now Orkay I can't even see. I sold Infosys at a very early stage, but I held on to Hero Honda, Sun Pharma and all for long periods of time. So there's been no right wrong. So a lot of things that I did, some right, some wrong, but yes, picking up good stocks at a good price is very important. So first of all, to pick great stocks and get out of the way of compounding. I completely agree. It has worked for me. I have picked up great stocks and held on for 30-40 years, and it has worked for me, right? 1977, must thank George Fernandez for kicking out all these FERA companies who were forced to dilute. The second point that the report talks about is know what you own. This is very important. Like for example, I zeroed in on the Murugappa group in 1986-87. So I've been buying shares right since then. So 1986 would mean about 35-36 years of trusting that management. 1977-78 for Reliance and HDFC group. Right, so these have been trusted over long periods of time, but this is the first time the Murugappa group is now no longer Murugappa group. It is split into different parts. Which part to trust, what to do, I now don't have the ability to look for it. So I don't have the ability to find out which is a good part, bad part, which industry is good. Should I keep Carborundum Universal and sell off Cholamandalam? I am today not very capable of making those decisions. So going forward, I do not know what I will do. Similarly, I do not know how HDFC will be without Deepak Parekh and Mr. Aditya Puri. I have no clue, but as of now, I am holding. Right, so Reliance also, we saw the transition from Dhirubhai to Mukesh Anil and then only Mukesh. We saw the transition was good. How will it be from Mukesh Bhai to the others? I don't know whether I will have the competence. So knowing what you own, why you own, what they are doing, what is the change that is happening in their management, all that is very important. So know the company in which you have invested is important. Third is quality of management. Now, quality of management I think is exaggerated. As far as I am concerned, the quality of management should be reasonably good. I don't want the best. I don't want a company which hires only from Ivy League and IIM and IIT, and I don't think ICICI is a great example of what a company should be doing while hiring. It hired the best, but it took a very, very long time, and only under the current leadership is it getting a PE comparable to HDFC. Earlier it used to get a much worse PE and PB, right? So I think as long as my management stays out of controversies, I'm happy. So I'm happy with the Supreme Industries, I'm happy with Sundaram, I'm happy with an Eicher Motor, I'm very happy with the Murugappa Group, HDFC Group, Reliance. As long as you don't be in the headlines or page 3 or you create a mess, as long as you don't do that, I'm fine. I don't have the ability or the competence to find out what is good quality management. I mean, I don't have the ability to find out. Why should I keep saying I have the ability to find out? Morgan Stanley also says that it has benchmarks, and it also tells us that benchmarks are not always useful, which is completely right, because if you hug the benchmark, you will get benchmark performance. If you try to get away from the benchmark, you could get alpha, but you could also make a loss. So I personally, in my own investment, which is what I'm talking about, I don't even have benchmarks. I'm happy with the growth that is happening, because my dividend income is more than my household expenses. So I really don't have too much. I don't measure too much, which is not very good, but I keep looking once in a while at the IRR, and I'm quite happy with the IRR that I receive. But do I do a regular quarterly performance review and see what to change? No, I don't. I am a very bottom up kind of a person, so to me it doesn't really matter. But the number of companies that I hold is much greater than what all great people suggest. People suggest 10 to 15 companies, for given my size of portfolio, I must be struggling with 50. Yes, of course, portfolio sizing is not something very easy. I'm trying to learn it over a period of time, but still I can't do very many big transactions. I have to do many small transactions, right? So I keep saying it's like my eating idli. I can eat 2 at a time, right? So if I have to eat 500 idlis, it will take me maybe 2 years. I'm not going to eat idli every day, and I'm not going to eat more than 2 every day. So it takes me a long time to eat idli. So similarly, my portfolio gets built over a longer period of time than what people would like to. I don't invest so quickly in any company. I hold on for some time, see how it is working, and then keep adding. But I keep adding up and I keep adding down, depending on the conviction that I have in the management. So one thing which he says is risk management should be absolute, not relative. First of all, risk management is the most important thing you do. Like Nimish Shah of ICICI Prudential says, I run ICICI Prudential risk management. Fund management is incidental to it. Completely right. You are here to make sure that you do not lose money, right? You do not lose money in a big way. So you take a bet on some company and hold on for a long period of time, and you keep adding. Right now I have 2 companies in which I have a 10-year view, and I'm going to add some shares every month. They are right now building market share. They don't have profitability. They are in bad shape as far as the P&L is concerned, but that does not matter to me. I'm happy building my portfolio with them, and that is my risk management, because overall I've kept a limit of X amount which I'll put in these companies and keep seeing what is my IRR. But I will look at my IRR only after 5-6 years. Right now there can't be any IRR, though I am still in the green in both. The returns are not too great, but I am happy building my portfolio in those 2 companies. So risk management. Morgan Stanley also says that what you do not own is just as important as what you own. I completely agree, because within my limitations and within my understanding, certain companies which are not good for the country or not good for the world are something which I don't own. Now India does not have any arms and ammunition manufacturer, not in a big way at least. But I own shares of Hindustan Aeronautics, right? Hindustan Aeronautics, technically speaking, is an airplane manufacturer. In fact, for people who do not know, it was started by Walchand Hirachand. So we keep talking of J.R.D. Tata as the father of civil aviation, but the father of aviation manufacturing in India is Walchand Hirachand. Sorry, that's so. Similarly, I do not own any shares of Monsanto, which I thought was responsible for many farmer suicides, and I do not hold any shares of ITC, which I thought was creating cancer. These are my views, and obviously because of this the returns on my portfolio should be lesser, but I have been holding shares for a very long time, and this great wisdom came to me only about 7-8 years ago, maybe 10 years ago, that I stopped holding, or maybe even less than that, for Monsanto and ITC. And because I remember I sold ITC and I bought Siemens, and I thought my returns will go down, but actually ITC fell and Siemens went up dramatically. So I think it's just God's way of saying, okay, here's a good decision, so I'll get rewarded. No, but jokes apart, I personally did not like that industry which was causing harm, so I didn't buy. But what you do not own is just as important as what you own. You have to know that, okay, इसमें पैसा बनेगा, इसमें नहीं बनेगा. Sometimes you are wrong, sometimes you make money thinking of something else, but you make money in some other share, right? It's like Shah Rukh Khan saying, I did this great acting and that movie didn't do well, and I did this bad acting and that movie did very well. So sometimes your luck plays out, you're in the right industry at the right time, right? So when the TCS IPO came, I thought it was a good share to buy and hold, because it was a Tata Group share, it was in software industry, and for very many generations, or rather for a full generation, there had not been a Tata Group IPO. So I said this should be a good share to buy, and I have benefited. So it's some part luck, part hunch, part intuition, whatever you want to call it. Express your conviction in okay, one thing which I slightly differ from Morgan Stanley and from Warren Buffett is to say that have a concentrated portfolio. I struggle with that. I can't have a concentrated portfolio, because if I like two companies, I'll own both, like Goodless Nerolac, or whatever the new name is, Kansai Nerolac, and Asian Paints. So I can't run a concentrated portfolio. I try running a concentrated portfolio, but what happens is concentration gets done over a period of time. Let's say about 10 lakhs rupees worth of some company shares. I built a portfolio. That 10 becomes 20, 30, 40, maybe a crore, 2 crores. Then I don't mind concentration. So my concentration is built up. The conviction is built up, rather than will I sell a share worth 2 crores to buy another share worth 2 crores? Extremely unlikely. My transaction sizes are much smaller, but my portfolio gets built to more than 2 crores. That is a different thing. So how I handle risk is that way. I'm not even saying it is right, because I learned portfolio sizing from Naren, and therefore I started doing bigger transactions. But it will still take me a long time to build a 2 crore portfolio. It's not one single transaction. It will be 5 lakhs, 2 lakhs, 7 lakhs, 10 lakhs. Oh, the market has fallen, another 5 lakhs. So similarly, my 2 crore portfolio will get built, plus there is appreciation. But will I ever be able to run a concentrated portfolio? Not in this birth, for sure. I might get more and more risk averse, so I will get more and more diversified rather than creating a concentrated portfolio. I can't. So one very important thing which Morgan Stanley says, it says in number 8, I would have put it number 1, is valuation matters. To me, that's very important. Like, I find some very good companies, but at very bad values, and I know I can wait it out. I'm not in a hurry to buy it. I said, well, this is a good company, so I should buy it. But it also happens sometimes that I miss out because of 5-10 rupees, and then I regret. So I don't have a value. Like, I will not say I will buy the share at 115. I will say anything from 105 to 125 is okay with me. If it is available at 125, so be it. I'll buy it. I won't add too much. But if it comes down to 105, I will buy more of it. Right, so I do that. So valuation is important, and I would have perhaps put it much higher. But yes, valuation, you wait for the right value to come, or you pick up some other company in the same industry, or you say, okay, I don't believe this valuation is right, but I will still put some money into it, saying, what if I am wrong? To me, that question which I keep asking is, what if I am wrong? So I speak to analysts to know what is the mistake I am making, and believe me, I make huge number of mistakes. So that you get to know only when you talk to the analyst who is handling the company on the day-to-day basis, and you realize how wrong you were about valuation. But yes, valuation is important. They also say that maintain a long-term view. That is something which has always worked for me, because I have a long-term portfolio on which I can do delivery-based trading. I can buy some more shares, I can sell, I can take positions on both sides, because I hold, let's say I hold 30,000 shares of a company. I can take a 500 on call position and a 500 put position. because I have 30,000 shares, I can take a position of 500 in the long and in the short, because if I do sell it off, it's okay, because it will come to 29,500, and if I buy, it's okay, I have money to take delivery. So I use my portfolio to do delivery based trading. So yes, I have a long term view on the portfolio, and I may do transactions of only 500. So 500, 500, 500, I may sell at 3 prices. Let's say I think it is overvalued at 110. So I'll sell it at 110, I'll sell it at 115, and sell it at 120. At 120, I'll stop, because what if I am wrong and the market is trying to tell me something, saying, idiot, 110 is not overvalued, see at 120 there are still buyers, and 125 there are still buyers, then I'll hold on. So at worst, I could have got rid of 1500 shares out of 30,000. So that's perfectly all right. Similarly, instead of 30,000, I may be holding 35,000. I may have bought a little more. Then if my portfolio size has increased, I will use it as a sizing opportunity. Or if I get a chance that I buy the share at 642 and it becomes 712 within a day or two, I'll trade out also. I know the market will come back to this price, so I do that. So long term view, yes, but a short term trading position also. Morgan Stanley also says, remain curious. That is bound to happen. You will remain curious, because I keep reading Ashwath Damodaran, and Ashwath Damodaran's recommended 47 rupees is when I entered Zomato. I bought, sold, I did everything. I'm still in the green. And I have not bought Paytm, though, even though Ashwath said it is a good buy at 2000. I just didn't believe that after the introduction of Beam, I did not believe the Paytm model is going to work too well. I still have no view on that, but it forces me to take a view on everything and saying I will look at everything and then decide not to buy. So I did not buy Paytm, which means it's a positive decision of having seen and decided not to buy. It is not as though I didn't see. Nykaa I saw, I didn't understand the model, I didn't buy. Paytm, I didn't like the model, so I didn't buy. Zomato I have bought, but at prices which Ashwath Damodaran said, and then I saw a jump, I sold, I bought, I sold. So I'm in the green and I'm happy building a portfolio. Similarly, Indigo, I bought, sold, and I still hold a portfolio where I am in the green. So some of these things you keep doing, you keep remaining curious, and at some stage I'll stop doing that and put in an index fund. But right now I'm curious. Thank you.